Okay, welcome back to the second part of our workshop today. It's quite intensive, but I see that there is an interplay, and I would like to see more interplay with the participants to make it more lively. Now we are going to have two speakers from the University Erasmus from Rotterdam, Walter De Wit and Martijn Schippers. They are going to make a presentation on the administrative interplays between customs value and transfer pricing, and in more specifically retroactive adjustments, advanced rulings, common documentation, and special schemes. So I'll give the floor to Martijn Schippers. Please.
Thank you. Thank you for hosting us, Santiago. We're pleased to be here. Indeed, we are going to reflect on the administrative interplays between customs valuation and transfer pricing. And we will do so by discussing 4 subtopics. I will do the first 2, and then I will hand over to Walter, who will address the other 2 topics. So first, we're going to talk about common documentation, and then we mainly focus on transfer pricing documentation and how that can be of help to prove that the price has not been influenced by the relationship between the seller and the buyer, but also how transfer pricing documentation can be of help for customs authorities to see whether there are corrections being made to the transfer prices, and maybe that can be used then to make also corrections to the customs. Then we jump to another subtopic, transfer pricing adjustments. Not only retroactive transfer pricing adjustments, but also some slides about prospective transfer price adjustments. We are not talking then about Hamamatsu and articles, because that will be addressed by our German colleagues. But what we will do is discuss all kinds of transfer pricing adjustments which are out there. So primary adjustments, secondary adjustments, compensating adjustments, etc. And what the impact of those adjustments will be on setting the customs value. Then something about advanced rulings. We discussed advanced ruling in other countries as well as in the EU, because there are some changes upcoming. That will be discussed by Walter. And he will discuss also special schemes. So how to make sure that you take into account the transfer pricing adjustments for setting your final customs value, which kind of mechanisms are embedded in the Union Customs Code. Now, that being said, few steps back, and if you import a product, you need to determine, of course, the customs value. And if you determine the customs value, there is 6 methodologies out there, 6 methods are out there, and there's a strict mandatory hierarchy between those methods. And the primary and preferred custom valuation mechanism, which we heard already at the beginning of this morning, is the transaction value method. And the definition of a transaction value method is that it is the price paid or payable for the goods being sold for export to the country of importation. In this regards the EU customs territory. The question, of course, is what is then that customs value? It's more or less the invoice price. The invoice price settled between the buyer and the seller. And on numerous cases, the European Court of Justice already said it should reflect the economic value of the imported product. And that's also why we see a certain mechanism back in the Union Customs Code to make sure that the customs value represent the economic value. And we see price adjustments being made in Article 71 and 72, and we see some conditions laid down in Article 70, paragraph 3. And the most important one, of course, for this today's discussion is then stated on the D, where you find back that if you have a related party transaction, that price should not be influenced by the relationship. Otherwise, you cannot use the transaction value method. And then the question comes up, okay, how do I make sure that that price has not been influenced by the relationship? And it was already discussed this morning, but then you've got in Article 134 of the Implementing Act a provision where you can find the methodologies to prove that the price has not been influenced. And I put them here on the slide. The first one is that is the one you can find in paragraph 2 is the test values. But the problem with the test values is that they look similar to the alternative valuation methods, but they are even more strict to apply. So in practice, we hardly see any operator using those test values because it's putting a huge administrative burden on the importer, that's one. And secondly, sometimes the information is not even available because the restrictions that comes with applying test values cannot be met. So what you can do then is, of course, perform a circumstantial sales test. So what is that? You can, put it in my own words, as an importer, provide any documentation you want to the customs authorities to prove that the price has not been influenced by the relationship between the buyer and the seller. Well, if you then look to the Union Customs Code, the legal package, there's not much guidance about how to perform such test. But if you look to the WCO, or the WTO, the Custom Valuation Agreement, and then the integrated note to Article 1, what we find back there is three kind of questions. And if you meet or can answer one of the questions in the affirmative, then you meet that circumstantial sales test. Now, I've put them here on slide, those three questions. And the first one is if your pricing methodology is consistent with normal pricing practices in the industry. That is one of the things you can do. If you have information about that, then you can meet that circumstantial sales test. But also if you have a product and you sell to a third party, but also to a related party, and you use the same price, that is also an indication that your price has not been influenced. And then the last one, if that price is adequate to recover all costs and a reasonable profit, so to speak, then you're also meeting this test. And for a long period, the question came up, can we use transfer pricing documentation as a means to answer one of the three questions? Well, with publication of Commentary 23.1 of the Technical Committee on Customs Valuation, it became quite clear that in transfer pricing documentation there's information that's very valuable when performing such a circumstantial sales test. The question, however, is we've got different methodologies out there for transfer pricing purposes. We've got the traditional transfer pricing methods, which are more focused on the transaction, and you've got the profit-driven methods. And then the question comes up, okay, but is a transfer pricing document where you have a transfer price that is built up using one of the value-driven, profit-driven custom valuation or transfer pricing methods, can you also make use of those TP docs? And then we saw a case study 14.1, again from the Technical Committee on Custom Valuation, where the Technical Commission said also when you use a TNM, that's a profit-driven method, you can make use of the transfer pricing report with regard to the circumstantial sales test. You can use it to prove that your price has not been influenced. Well, we also saw that back in the WCO guide to transfer pricing custom valuation, that was published in 2015 and later updated in 2018. There again, the technical committee said transfer pricing documentation includes valuable information for the purpose of proving that prices have not been influenced by related parties. But the thing is that if you look to each of these questions, in particular the first and the third question, you need to perform a kind of a comparability study to see what parties in the industry use as a pricing strategy. Do you want to compare that? And there's not much guidance still out there on how to do that for custom valuation purposes. And then we've got the TP guidelines of the OECD, and there you have like all kinds of indicators which can also be used, in my view, to perform a circumstantial sales test and to perform a kind of a comparability study to similar industries to find out whether your price whether your pricing strategy is similar to the pricing strategy of unrelated parties. Well, you see here, for instance, that you can look at the contractual terms, the functions that are being performed, the characteristics of the property transferred or service provided, the economic circumstance, of course, and also the business strategies. So all kinds of factors which you can factor in by performing a kind of comparability study. And with regard to the industry you are in, these are typically the kind of factors which you can use to see whether you're comparing yourself with a similar or identical industry. So you are going to look to the geographical location, the market size, barriers to entry, etc., etc. So all kind of things which you can find in the OSD pricing guidelines, which are not in cost evaluation guidance to be found. But I think making use of the OECD transfer pricing guidelines can be very useful also with regard to proving that your price has not been influenced. So that is one, but that is from the view from the importer, so to speak. Then also the question comes up, is there documentation out there that is submitted to tax authorities, which can also be used by customs authorities? What we now see after BEPS, that's the first stage of BEPS, is that we now have a three-tiered approach for documenting intercompany transactions. We've got the so-called master file, we've got the local file, which needs to be submitted in every country, and then you've got the country-by-country report. And I've listed all kinds of data which is included in the master file, local file, country-by-country report, which can be used also by customs authorities to see whether the established prices are not influenced. You can also find back there whether there are like agreements being made with the tax authorities about the arm's length nature of the transaction, what the policy behind adjustments exactly is. So all kinds of things are in there, which also can be used, I guess, by customs authorities to see, okay, is this company, what is the pricing strategy exactly? And are the prices at arm's length? What type of adjustments are being made? And then they can make up their mind themselves to see what they need to do for cost evaluation purposes. So this is a little bit about common documentation, but then more from a transfer pricing perspective. So what can customs authorities and importers do with transfer pricing documentation and guidelines that are out there? Well, that's something about adjustments. This is nowhere to be found in legislation. This is just my own personal view. But I think if you want to take into account the transfer pricing adjustments, then you need to meet certain conditions. The first one should be that the price should really have an impact on the price paid or payable. So that means basically that you need to send a credit or a debit invoice. That's one. The second one is that it should relate to the imported goods. That seems to be an obvious one, but what we see sometimes in practice is that an invoice is sent and that simply puts on the invoice lump sum TP correction, with no distinction being made to which kind of goods it relates to. That could also be goods purchased domestically, that could also be a service. So it should relate to the imported goods. That's a tricky one in practice, typically. Then it should also happen within the stage of limitation, which is typically in the EU 3 years. And then you can debate, okay, can you also extend it to 5 or 10 years, depending on the EU member state, because if you make a TP correction which you should take into account for setting your final custom value. Is that then something that gives rise to a criminal offense, and can you therefore go back 5 to 10 years, or is it up to 3 years? But that's open for debate. Another thing, you should have documentation available prior import, so there needs to be a TP report that says, okay, I set the transfer price, that can be adjustment later on. That you also find back in one of the instruments of the WCO where they talk about review clauses. There should be some documentation ready up front that says at a later stage the price can be adjusted under certain conditions. But again, this is my personal view. Let's take a look at the different transfer price adjustment, or before that, the difference between price setting approach and outcome approach. That's also an important one, I guess. What is that? You've got the price setting approach, and then you set a transfer price based on predictions, forecasts that you make, and that is then your final transfer price. So you do not make any adjustments. This is not accepted in every country yet, and it's sometimes also hard for businesses to make such kind of predictions and forecasts. But I think with all kinds of digital developments, etc., this is an approach that will be applied more and more often. And if companies would use this approach and do not make any adjustments, then the whole problem with the interplay between cost evaluation and transfer pricing, or at least part of it, is solved. But luckily for us, there are still a lot of problems still, because most companies still apply the outcome approach, whereby you take a transfer price and at the end of the year you're going to make sure that it is still at arm's length by making adjustments. In 90% of all cases, I think the outcome approach is still being applied. And then, of course, the question comes up, do I need to make an adjustment? That really depends also on the transfer pricing method that you apply. Typically, when you apply the traditional method, so cost plus, CAP, or resale minus, then there is no need to make an adjustment. But most companies, 90% of all cases, use a profit-driven methodology, so profit split or TNM, and then typically there is a need to make a correction. And then I make a distinction between 5 retroactive adjustments, which I will now explain, and also give my comments on what the impact exactly is for cost evaluation purposes. So the first one is the primary adjustment. So what is that? As a taxpayer, you submit your corporate income tax return, and then the tax authorities, they have doubts about the profit that you included in that return. They say this is too low, and they make a correction that we call a primary adjustment. So there's an adjustment in the corporate income tax return. It does not lead to an adjustment to the commercial prices. So at first glance, you would say no impact from a cost evaluation perspective. Now, well, if the profit goes up in one country, you want to lower the profit in another country. And that is what you can do by making a corresponding adjustment. But again, there's no need to make a correction to the commercial price. So again, you would think there's no impact on your custom value. It can happen that you want to also reflect that adjustment in your tax return also in your book of accounts, and that you can do so by giving dividend or making another kind of adjustment. And the tax treatment of that, we call that the secondary adjustment. And if that takes the form of a payment and correction to the commercial price, that is very interesting, because then you would say that can be taken into account for setting your final customs value. But then take a step back to the primary and corresponding adjustment. Does it really not have an impact on your customs value? Because basically what the tax authorities are arguing in that situation, at least for a primary adjustment, is that the profit that you included in your tax return was too low. It should be higher. In other words, the transfer price that was being used was incorrect. It was not at arm's length. You do not reflect it in your commercial price, but your transfer price is not correct. So what you can debate, at least, is that you say, if you do not make a correction to your commercial price, but your profit is not allocated correctly, and thus your transfer price is not at arm's length, your price is influenced. And that's a little bit similar to the case study 14.2 from the technical committee, where we had a import of luxury bags, and the profit was much higher than expected, and they did not take any transfer price adjustment into account, or at least they did not make a correction to commercial prices. And what was the conclusion of the technical committee? We should reject the transaction value method. So I think each of these adjustments can have an impact on determining your customs value. Now then, 4 and 5. At the end of the year, it could happen that the taxpayer says, okay, I expect that the tax authorities will make a primary adjustment. I want to prevent that, so I make a compensating adjustment. But again, also with the compensating adjustment, there's no need to adjust the commercial prices, but still you can argue in the same line as I did just now, that it has an impact and could maybe even lead to the rejection of the transaction method. And then the fifth adjustment, I think that's the most common one, the year-end adjustment. And then a journal entry is made, commercial prices are being adjusted, and then I would say you should take that one into account, because then not only your transfer prices are arm's length, but that you can also take care that your customs value has not been influenced by the relationship between the buyer and the seller. But we can also have prospective transfer price adjustments, and more companies are making such adjustments. And the question is, what does that mean for custom valuation purposes? Take the example that a company should reach a target profit of 2. I will see that here on this slide. But after the first quarter, by applying the transfer prices, they will reach a target a profit of 5. If they would not do something, at the end of the year the profit would be 5 instead of 2. And what do? They adjust the transfer prices, and the profit will be lower. And then on average, at the end of the year, you will reach the profit target of 2. But if the profit is lower, then you use a higher transfer price, which will be typically accepted, because if the customs value is higher, I think customs authorities will not complain about it, of course. At least not for quarter 2, 3, or 4. They could have arguments that they put in place for quarter 1, where they say it was too low. Yes? But on average, at the end of the year, they used a custom value that was not influenced, argue. So the question is, can this be accepted? And I think in a lot of instances you can make arrangements with customs authorities that they allow such practices, but not all customs authorities allow you to do so. Especially if you take this situation, where you have a target profit of 4, and the transfer price that you use resulted in a very low profit in the first quarter, and then you want to make, you make adjustments for part 2, 3 and 4. You take a very low transfer price so that your profit goes up. So that on average at the end of the year you've got a target profit still of 4. But yeah, then you apply a custom value that is below the arm's length range. And will that then be accepted by the customs authorities? That is, of course, a question which will need to be dealt with in the future in much more instances, because companies are making more and more these kind of prospective transfer price adjustments. That being said, I'm going to hand over to you.
Yeah.
Do we need to use your spaces?
Okay. So from transfer pricing adjustments, we go to advanced rulings. Yeah, and we saw from the WTO, and that's more a general statement, actually says it should be encouraged that members of the WTO issue advanced rulings in the field of customs, and also in the field of determining the customs value under a particular set of facts. Yeah, what we see is, and we'll come to the position of the EU in a minute, because there are, I think most of you will know, there are some developments currently. But if we look around in the world, then we see
Both of them.
yeah, I know which one is which. New Zealand and Australia. I can't. Well, we see New Zealand and Australia. Which one is which? I don't know, but they have valuation rulings, and we see the first one is indeed public even, which is of course a very good thing. And in the example of the US, and I mean, I've also been working with US consultants, and they usually refer to public rulings on customs valuation, which is very useful, because then it's very predictable what the customs authorities might think about a certain setup. So in terms of transparency towards businesses, I guess that is a really a good thing. But if you look at, then we also have South Korea, which have a combined advanced customs valuation arrangement and an advanced customs agreement. And they, in 2014, they introduced traditional TP methods, and in 2018 it was also agreed that this could be applied on other TP methods, like profit sharing methodologies, for example. And yeah, in certain EU member states you see this also, that TP adjustments can sometimes be taken into account when customs authorities allow it, but they want the importer to take contact with them, to agree with them what they are going to do, how it's going to be done, and then they would allow it. And that's also what you see here in South Korea. The importer must hold a advanced customs agreement and an advanced customs valuation agreement. And yeah, then you can of course also take into account additional payment or refund of customs duties. Yeah, if we look to the position of the EU, then the customs authorities can issue binding information on all kinds of things actually, because we have BTI of course in the binding tariff information and the binding origin information in the UCC, but there is in Article 35 a more general basis for binding information in general on customs issues. So that would also be the customs valuation custom value information, the CVI. There was a public consultation, and there were a lot of these responses, actually 200, that's substantial. 53 responded that transfer pricing is why the provision of transaction value are more challenging in practice. And 87% actually said, okay, we are interested in obtaining a customs valuation ruling. And 72% would apply to inter alia to cover the impact of transfer pricing adjustments. So that should be also a part. And I have to look at the next slide. Maybe you go back to this one for my own commentary. And I think because what I understand now is that the Commission is really making pace with this, and they are actually planning to implement binding information on customs value. I think, but there are also problems, I guess. I mean, we know the BTI and the binding origin on information, and in my view, if you talk about those issues in customs, it's more black and white. You can classify a product, and this is the product, and it's clear what the facts are. But if you talk about customs valuation, then it's much more fluid. There's much more gray areas. The facts are not always clear. So I think it will be difficult. It will be challenging to come up with good customs valuation binding information from the authorities. And also, what I also think is important, you see here, for example, at the bottom of this slide, the impact of transfer pricing adjustment should also be covered. But the thing is, on a lot of things, issues in customs valuation, the solution is not clear. The legislation is not clear. You are going to talk about Hamamatsu, which is a case which has not brought much clarity in the field of transfer pricing adjustments. But so what if one customs authority is issuing and binding information on customs value, allowing transfer pricing adjustments? And then others are bound by it, but they may think, yeah, but I do not agree with it, it's not in the legislation actually. So what I would say is, I think it is important that the legislation is also made clearer in this field. If you talk about transfer pricing here, then it's also important that there is some clarity in the legislation on what is allowed and what is not. And we will come to that a little bit in a few moments as well. Then if we talk about special schemes, which is the last subject actually of this our presentation, then if you look in the WCO guide on customs valuation and transfer pricing, they talk about the price review clause, which is actually the final determination of the price payable, being subject to certain factors which are set forth in the provisions of the contract itself. And it concludes that such clauses should not of themselves preclude valuation under Article 1, under the transaction value methodology. And so, in other words, a price review clause should not endanger the application of the transaction value methodology. And they can be compared with a situation where a transfer price is being used, which is subject to a subsequent adjustment. And it was actually found problematic by the Court of Justice, of course, in Hamamatsu. But WCO thinks differently about that. Special schemes. A big example, I guess, if you talk about transfer pricing and customs valuation, is the situation in the US, where they actually have what we call a reconciliation program, and that means actually that at year end you you look at, okay, what were the transfer pricing adjustments made, and what was the impact on the transaction value that I used, and then you file either a refund request or you pay an additional amount of customs duties. That is actually supported by legislation and rules in the US, and it is successful, and it is also let me say that taken in good by businesses. If we look to the European Union, then we can refer to the minutes of the 4th meeting of the Customs Expert Group, the evaluation section of that, and they said that the first step to be made in each of transactions between related parties is to see, of course, whether the relationship influences the price. But when it is declared that the relationship did not influence the price, if the operator lodges a normal final declaration, no adjustments deriving from the transfer pricing arrangement will be possible. If using a simplified declaration, and so then you leave open the customs value, you could say, okay, I do not know what the customs value will be, but later on when I know the final value, I will adjust it. Then the experts group says these adjustments may be possible, subject to the test that the relationship does not influence the resulting price. And that's the circumstances of sale test. Martijn discussed it. Flat rate adjustments are not permitted, customs expert group says.
In my view, this is similar to the American Reconciliation Program.
Yeah.
You declare a provisional value, and then you come back. If you declare the value as provisional, then you come back with an adjustment. So in the end, we are coming.
I do not totally agree with you. Why? But I'm now going to say something which is on one of the next slides. Because this would what this involves is that you need to amend or complete retroactively, of course, the simplified declaration separately. And if you have a big business which has thousands of imports, they need to change thousands of simplified customs declarations. So that involves a lot of administrative work. And if you look at the US situation, then it is actually what happens there is what Hamamatsu did. They file a spreadsheet, an Excel sheet with a average duty rate, and then the result is the same, absolutely the same. But it's the work involved, let me say it like that. So what I'm now going to discuss is, well, that was my next slide, which special schemes could apply. I'm not saying that they do apply, but I'm just investigating now a little bit, okay, these schemes are available and can they be used? And as we just saw, simplified declaration is one of the solutions. And it's actually also the preferred solution of the European Commission, you could say, because what is significant, I guess, is the period of time, the 120 days plus 2 years, has been changed as of the 1st of July last year. And while not giving a very explicit reason, I assume that it has to do with the Hamamatsu case. That the Commission has said, okay, we must extend this period of time so that companies are able to change retroactively the customs value. And so I guess this is the preferred solution of the EU Commission for now, because for the rest the Commission has been silent, of course, after Hamamatsu. So this is the solution. Then the other one, which is also, at least in the Netherlands, the customs authorities are suggesting that this could be a way forward, is what I call the customs valuation license of Article 73 of the Union Customs Code, which is actually in the Delegated Act Article 71, which has more specific conditions. But that scheme is actually meant to include, for example, royalties, assists, R&D, which are also big sums of money, but you don't know before, at the moment of import, you don't know how big the part is you need to add to the customs value. Customs authorities are sometimes saying, you can also use this for transfer pricing purposes, to reflect that in the customs value. And if I'm very honest, I find it very difficult to see how this would work. I can see it with royalties, and because I saw it in practice with assists, R&D. You make an estimate, okay, this is going to be the value this year, and then you fix the percentage and you add it to the customs value. And then at the end of the year, you look, okay, was the percentage correct, or does it need to be corrected? I will say a little bit more about that later on. But if you talk about transfer pricing, I think it's very difficult to see. You can say maybe that's what they mean. Okay, I think that this will be the price during this year, and then you must use that price according to this Article 73. But it's not meant. The possibility of this article was not meant, I think, for transfer pricing. And what is also another thing which I think is very important. In practice, and I've seen it being used for royalties, assists, and R&D. What you see is that you file a reconciliation the next year on the previous year to show to the customs authorities. Okay, I use, for example, a percentage of 6 above all my imports. On the customs value of all my imports, 6% is added. But what happens at the end of the year if you overstated the customs value or understated the customs value? The legislation is actually silent on that. I know the Dutch customs authorities say, okay, if you overstate it, you will not get a refund. If you understate it, we will not retroactively assess. But of course what will happen is that maybe next year you need to add a higher percentage or a lower percentage to better reflect the customs value. And so this is also one of the proposed methodologies. I don't know if it works, to be true again. Then the other one is amending the customs declaration. To be true, and also in the Netherlands there is a lot of debate about the scope of this article. I think that under the Community Customs Code there were much more possibilities to amend a customs declaration. It seems that the current legislation is much more restrictive. And that also has to do with the fact that you cannot adjust a customs declaration after the release of the goods by the authorities. And normally speaking, I would say, transfer pricing adjustment will take place, and then the goods are already long ago have been released by the customs authorities. So it doesn't seem to be a solution. And then you can ask yourself, in the case of downward adjustment, can I ask for a refund based on Article 116 or 117? That has actually been rejected by the court, of course, in Amamatsu. So that also seems very difficult. Then my last slide, I think. What also happens in practice, but I guess this is totally outside legislation. There are customs authorities saying, okay, Hamamatsu is a very special case. We only apply it if facts are totally the same, then we will apply it. But if not, then we will go on and continue our routine that we always practice. And that is actually looks a lot like what we see in the US. You file an annual reconciliation sheet after the year has ended. Show, okay, this was my custom value. I have now included all the transfer pricing adjustments to that custom value, and it results this year in a refund or it results in an additional payment. Not foreseen in legislation again, but yeah, practice. You need to do something in practice if you want to do something with transfer pricing adjustments. So, yeah, maybe then to finish off. So I think the simplified declaration on paper, it looks like a solution, but I think if you are an importer with hundreds or thousands of import declarations a year, it is problematic. So I hope this study then will give a boost to a better solution. Thank you.